You've seen news headlines like RBI raises interest rates, bond yields surge, or foreign investors dump Indian bonds, or perhaps the most confusing one, bonds prices crashes as yields hit a 5-year high. If you've ever read that and thought, wait, what even is a bond? Who is buying it, and why does its price crash when yields go up? Shouldn't they move together? You're not alone. Bonds are probably the most talked about and least understood financial product for everyday investors. By the end of this episode, every one of those headlines will make complete sense, and you will understand a relationship that even many stock market investors don't fully grasp. Hey, I'm Adam, and welcome to Big Brain Buddy. Quick question before we start. Does financial jargon make your head spin? SIP, XIRR, TDS, CAGR. If you have ever stared at one of those words and quietly thought, what does that even mean? This series is for you. The series is called Small Steps, Big Wealth. We take one financial product at a time, strip the jargon out, and explain it like a real person should have explained it to you years ago. Today, bonds. Let's get into it. You've heard the word bonds thrown around in news, in movies, in conversations about investing. But what actually is a bond? Who issues it? Who buys it? And why should you care? Here's the one line version. A bond is a loan, but flipped. Instead of you going to a bank to borrow money, a government or company comes to you to borrow money. You lend them a fixed amount. They promise to pay you a fixed interest called a coupon at regular intervals. And at the end of the agreed period, they return your full principal. That's it. A bond is you being the bank. Now, to understand every layer of how bonds work, we're going to use one analogy throughout this episode: a job offer letter. Imagine you receive a job offer. The contract says 60,000 per month, fixed salary for 3 years. At the end of 3 years, the contract ends and the company pays you a final settlement of 10 lakh. Now map that to a bond. The 10 lakh settlement, that's the face value of the bond, the principal amount returned at maturity. The 60,000 monthly salary, that's the coupon, the fixed interest paid at regular intervals. The 3-year contract duration, that's the tenure or maturity period. The company that hired you, that's the bond issuer, could be the government, a bank, or a private company. And you're the bondholder, the investor. Every time you hear a bond related term from here on, just map it back to this job offer. Let's start with who's on the other side of this deal: the issuer. The government, when the Indian government needs money to build highways, fund defense, or manage its budget deficit, it issues bonds called government securities or G6. These are considered the safest bonds in India because the government can always print money to repay. It will never technically default on a rupee denominated bond. RBI Treasury bills, the shorter version of G6. Tenures of 91 days, 182 days, or 364 days. No coupon payments, instead, you buy them at a discount and receive the full face value at a maturity. Companies. When a company like Tata or Reliance wants to expand but doesn't want to dilute its shares, it issues corporate bonds. Higher interest than the government bonds, but higher risk too, because companies, unlike governments, can default. Banks issue bonds called debentures to raise long term capital. Going back to our analogy, the government offering you a job is the safest employer. A startup offering the same contract comes with higher pay, but you're risking that the company might shut down before your 3 years are up. Let's quickly lock down the core vocabulary before we go deeper. Face value, the principal amount of the bond. Most Indian government bonds have a face value of rupees 1000. This is what you get back at maturity. In our analogy, the 10 lakh final settlement is this: coupon rate, the fixed annual interest rate stated on the bond. A bond with a face value of 1000 and a coupon rate of 7% pays you 70 rupees per year, typically in two installments of 35 rupees each. This is your fixed monthly salary. It never changes regardless of what happens in the market. Maturity date. The date on which the issuer repays your principal. Could be 1 year away or 30 years away. Yield. The actual return you're getting based on the price you paid for the bond. If the coupon is fixed but the price changes, the yield changes. Credit rating. A score given by agencies like CRISIL or ICRA. AAA is the safest. As you go lower, AA, A, triple B, the risk increases and so does the coupon offered. Here is the concept that confuses almost everyone the first time, and once you get it, you'll never forget it. When the interest rates go up, bond prices go down. When interest rates go down, bond prices go up. They always move in opposite directions. Let's prove this using our job offer. You signed a contract 6 months ago, 60,000 per month, 3-year tenure, 10 lakh settlement. You were happy. The market salary for your role at the time was exactly 60,000, so your offer was perfectly fair. Now fast forward 6 months. The job market heats up. Companies are now offering 80,000 per month for the same exact role. Suddenly your contract, locked at 60,000, looks less attractive compared to what's available outside. Now suppose you want to sell your job contract to someone else. Would they pay you the full 10 lakh face value for a contract that pays 60,000 when they could get 80,000 elsewhere? Absolutely not. They'd only take it if you sold it at a discount, maybe 7.5 lakhs, so that the effective return compensates for the lower monthly pay. That's exactly what happens in the bond market. When new bonds are issued at higher interest rates, existing bonds with lower coupons become less attractive. To sell them, you have to lower the price. Bond prices falls. Now flip it. The interest rates drop. New jobs in the market are offering only 40,000. Suddenly your 60,000 contract looks incredible. Everyone wants it. People will pay a premium to get their hands on it. Maybe 12 lakh instead of 10 lakhs. Bond price rises. The coupon never changed. 60,000 is 60,000. But the price of that contract moved based on what was available in the market. And that's the inverse relationship. Remember this, it comes up every single time bonds are discussed anywhere. This is where the previous scene connects to a new concept, yield. Your bond has a face value of 1000 and a coupon rate of 7%. That means it pays 70 rupees per year, always, no matter what. But now suppose you didn't buy it at 1000. You bought it in the secondary market from someone who needed to sell at 900. You paid 900 but you still receive 70 rupees per year in coupon. Your actual return is not 7% anymore. 70 divided by 900 is 7.78%. That's your yield. The real return based on what you actually paid. Going back to the job offer, imagine you got the contract transferred to you for 8 lakhs instead of 10 lakhs. The monthly salary is still 60,000, but your effective return on what you paid is now higher because you paid less for the same cash flows. Yield and coupon move in opposite directions to the price. Price goes up, yield goes down. Price goes down, yield goes up. This is why when you hear the 10-year bond yield rose to 7.2% today, that actually means bond prices fell. Two sides of the same coin. Just like FDs had different types, bonds come in several flavors. Fixed rate bonds, the coupon is fixed for the entire tenure. Predictable, straightforward. Your contract salary never changes. Floating rate bonds, the coupon resets periodically based on the benchmark rate, typically the RBI repo rate. When rates go up, the coupon goes up too. Your salary gets revised every quarter based on market conditions. Zero coupon bonds. No periodic interest payments at all. Instead, you buy the bond at a deep discount and receive the full face value at maturity. Treasury bills work this way. You buy a 1000 rupee T-bill for 960 and receive 1000 at maturity. Your 40 rupee gain is your interest. In job terms, no monthly salary but a very large settlement at the end. Sovereign gold bonds or SGBs issued by government, but the face value is linked to the price of gold. You get 2.5% interest per year plus whatever gold appreciates. A bond and a gold investment rolled into one. Convertible bonds. At maturity, instead of returning your principal in cash, the company can convert it into equity shares. Higher risk, higher upside potential. Tax free bonds. Typically issued by government infrastructure entities like NHAI or PFC, the interest earned is completely exempt from income tax. Lower coupon rate. But the post tax returns often beats taxable alternatives for investors in higher tax slabs. There are two ways to participate in the bond market. Primary market. You buy directly from the issuer when the bond is first launched. The government does this through RBI auctions. Retail investors can now participate directly through RBI Retail Direct platform, which lets you buy GSECs without going through a broker. Secondary market. Bonds already issued trade on stock exchanges just like shares. You can buy and sell them through your demat account. Prices fluctuate here based on the interest rate movements, credit events, and market sentiment, exactly like we discussed earlier. One important point: the bond market in India is significantly less liquid for retail investors than the stock market. Large trades happen between banks, mutual funds, and insurance companies. For retail investors, the more practical route is often debt mutual funds, which pool money and invest across multiple bonds, giving you diversification and liquidity in one product. Bonds are often called safe investments, but safe doesn't mean risk free. There are three risks every bond investor should understand. Credit risk, the risk that the issuer defaults and cannot repay you. Government bonds have near zero credit risk. Corporate bonds carry varying degrees. Always check the credit rating. A AAA bond from Tata is very different from a BB bond from an unknown company offering 14% interest. A job offer from an established MNC is fundamentally different from one from a cash burning startup. Interest rate risk. We have already covered this in detail. If you hold a bond and interest rate rise, the market value of your bond falls. This only hurts you if you sell the bond before maturity. If you hold to maturity, you get exactly what was promised. Time solves interest rate risk. Liquidity risk. Some bonds, especially corporate bonds, are thinly traded. If you need to sell urgently, you might not find a buyer at a fair price. Government bonds are far more liquid than corporate ones. Since we covered FDs in episode 1, let's quickly place bonds next to them so you know when to reach for which. The core difference in FD is a private contract between you and your bank. A bond is a market instrument. Its price breathes and moves every day. If you hold to maturity, it behaves like an FD. If you trade it, it behaves more like a stock. So, to recap, a bond is you lending money to a government or a company at a fixed coupon for a fixed tenure with your principal returned at maturity. The most important thing to remember: bond prices and interest rates always move in opposite directions. When rates go up, existing bond prices fall. When rates fall, existing bond prices rise. Understanding this one relationship puts you ahead of most retail investors. Check the credit rating before you invest. Know whether you are buying for income, for capital appreciation, or just for safety. And if direct bonds feel complex, debt mutual funds give you the same exposure with professional management and daily liquidity. See you in the next episode.